Preparing for a Erie Insurance Financial Analyst Interview Questions interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Erie Insurance and its business model? Erie Insurance is a property and casualty insurer known for its agency-based distribution model and strong presence in selected U.S. markets. It generates revenue primarily from premiums across products such as auto, homeowners, and commercial insurance, while investing collected funds until claims are paid. I would emphasize the balance between profitable underwriting, disciplined claims management, customer retention, and investment performance. As an analyst, I would connect financial results to policy growth, loss trends, expenses, and capital needs. While answering, focus on Erie's property and casualty focus, agency-based distribution, regional footprint, customer service reputation, diversified insurance products, and how premiums, claims, expenses, and investments drive financial performance. Question 2. Why do you want to work as a financial analyst at Erie Insurance? I am interested in Erie because insurance combines recurring revenue, uncertain claims, investment decisions, and detailed financial analysis. That creates a business where analysts must understand both numbers and operating drivers. Erie's customer-focused culture and agency relationships also make performance more connected to long-term trust than short-term transactions. I would bring strong Excel skills, careful attention to detail, and a structured approach to explaining variances so leaders can make better planning and resource allocation decisions. Make sure to cover your interest in insurance economics, analytical problem-solving, long-term business performance, Erie's culture and customer focus, and specific skills you would contribute through forecasting, reporting, and decision support. Question 3. How would you explain the main financial statements of an insurance company? The income statement shows earned premiums, claims incurred, operating expenses, investment income, and ultimately profit. The balance sheet includes invested assets, receivables, policyholder liabilities, loss reserves, and equity or surplus. Cash flow is especially important because premiums may arrive before claims are paid, allowing insurers to invest funds temporarily. I would also distinguish economic performance from statutory reporting, since regulators focus heavily on solvency, liquidity, and available capital rather than earnings alone. In your answer, talk about the income statement, balance sheet, and cash flow statement, emphasizing premiums, claims, reserves, investments, statutory capital, liquidity, and why insurance accounting differs from a typical industrial company. Question 4. What is the difference between written premium and earned premium? Written premium is the premium recorded when policies are bound or renewed, while earned premium is the portion recognized as coverage is provided. For example, a $1,200 annual policy typically earns about $100 per month, subject to the company's accounting conventions. The unearned portion remains a liability until coverage occurs. I would use written premium to assess new business and growth, but earned premium to compare revenue with the claims and expenses generated during the period. Be sure to mention the timing distinction, policy coverage period, premium recognition, unearned premium reserves, growth analysis, and why written premium can rise before revenue appears in reported results. Question 5. What is the combined ratio, and why is it important? The combined ratio equals the loss ratio plus the expense ratio. A ratio below 100% indicates underwriting profit, while a ratio above 100% indicates underwriting loss before investment income. I would not evaluate it mechanically, because catastrophe activity, reserve development, pricing changes, and business mix can distort a single period. The metric is valuable because it connects claims and operating efficiency, while investment income explains how the overall insurer can still earn profit despite underwriting losses. Focus on the combined ratio's loss and expense components, the 100% break-even concept, underwriting profitability, catastrophe effects, reserve development, and the need to interpret it alongside investment income. Question 6. How would you analyze a deterioration in Erie's loss ratio? I would first decompose the change into claim frequency, claim severity, catastrophe losses, and reserve development. Then I would compare trends by product, geography, vehicle type, and accident year. I would also test whether rate increases are keeping pace with inflation, repair costs, medical expenses, and exposure changes. Finally, I would separate current year underwriting performance from prior year reserve releases or strengthening. That analysis tells management whether the issue is temporary volatility or inadequate pricing and risk selection. Make sure to cover frequency, severity, exposure growth, pricing adequacy, catastrophe losses, claims handling, reserve development, mix changes, and separating current accident year trends from prior period adjustments. Question 7. How would you forecast insurance claims expense? I would begin with exposure forecasts, such as policy counts, miles driven, insured values, or payroll, depending on the product. I would apply expected claim frequency and severity assumptions, informed by historical trends, actuarial selections, inflation, and external loss cost data. I would separately model catastrophe claims and unusual events. I would then compare actual emergence with prior forecasts, document assumptions, and run sensitivities so decision-makers understand the range of possible outcomes. In your answer, discuss exposure-based forecasting, frequency and severity assumptions, historical development, catastrophe scenarios, inflation, seasonality, actuarial input, and sensitivity analysis around uncertain estimates. Question 8. What are loss reserves, and how would changes in reserves affect financial results? Loss reserves are estimated liabilities for claims that have occurred but have not yet been fully paid. They include amounts for reported claims and claims incurred but not reported. If expected ultimate losses increase, the insurer strengthens reserves, reducing current earnings and increasing liabilities. A reserve release has the opposite effect. I would evaluate changes by accident year and line of business, because development patterns reveal whether prior assumptions were conservative, accurate, or inadequate. Discuss reserves for reported and unreported claims, incurred losses, reserve strengthening or releases, earnings volatility, balance sheet liabilities, actuarial estimates, and the importance of monitoring development over time. Question 9. What is IBNR, and why is it difficult to estimate? IBNR means incurred but not reported claims, representing losses that have already happened but have not yet been reported or fully captured. Estimation is difficult because reporting lags vary by product, claim complexity, geography, and event type. Analysts and actuaries use historical development patterns, exposure data, emerging claims information, and selected assumptions. I would monitor actual emergence against estimates and investigate deviations, especially after catastrophes or changes in claims processes. Be sure to explain incurred but not reported claims, reporting delays, development triangles, claim frequency and severity, changing settlement patterns, catastrophe uncertainty, and actuarial judgment. Question 10. How do investment results affect an insurer's financial performance? Insurers invest premiums before claims and expenses are paid, so investment income is a major earnings contributor. Erie's portfolio would typically require careful attention to high-quality fixed income, duration, credit risk, liquidity, and regulatory capital. Rising rates may improve reinvestment yields but reduce the market value of existing bonds. I would distinguish recurring investment income from volatile realized or unrealized gains and evaluate results against liability timing, risk tolerance, and capital objectives. Focus on premium float, fixed income investments, interest rate sensitivity, realized and unrealized gains, credit quality, liquidity, duration matching, and the trade-off between yield and capital preservation. Question 11. If catastrophe losses were significantly above budget, how would you analyze the variance? I would quantify the variance by event, product, geography, claim count, and average severity, then distinguish gross losses from reinsurance recoveries and expenses. I would compare actual catastrophe activity with the budget's modeled assumptions and identify whether the result reflects random volatility or a change in exposure. I would also assess reserve adequacy, cash flow timing, and earnings impact. The conclusion should include both a clear explanation of the miss and recommendations for improving future planning. While answering, cover actual versus budget decomposition, event attribution, frequency and severity, reinsurance recoveries, reserve updates, geographic concentration, earnings impact, and whether assumptions should change going forward. Question 12. How would you build a financial forecast for an insurance business? I would build the forecast from operational drivers rather than simply applying a historical growth rate. Those drivers could include policies in force, retention, new business, pricing, exposure, claim frequency, severity, expense trends, and investment yields. I would translate written premium into earned premium using coverage timing, then model claims, expenses, investment income, and capital. I would include base, upside, downside, and catastrophe scenarios, with clear ownership for each assumption. Make sure to cover policy and exposure drivers, written and earned premium, loss and expense ratios, investment income, capital, scenarios, actual versus forecast updates, and collaboration with actuarial and operating teams. Question 13. Which financial and operating KPIs would you monitor at Erie Insurance? I would monitor written and earned premium growth, policies in force, retention, new business, and mix by product and geography. Profitability metrics would include the loss ratio, expense ratio, combined ratio, catastrophe losses, reserve development, and operating expense trends. I would also track investment income, portfolio yield, liquidity, capital adequacy, and agency productivity. The right dashboard should connect leading indicators, such as pricing and retention, with lagging outcomes, such as earnings and underwriting returns. In your answer, mention premium growth, retention, policy counts, combined ratio, loss ratio, expense ratio, catastrophe losses, reserve development, investment yield, capital adequacy, and customer or agency indicators. Question 14. Describe how you would perform a monthly financial variance analysis. I would begin by reconciling actual results to the approved budget and prior year, ensuring definitions and reporting periods are consistent. Next, I would decompose material variances into volume, rate, mix, timing, claims, expenses, and investment effects. I would speak with business owners to validate the operational explanation and distinguish one-time items from recurring trends. My final output would prioritize material issues, quantify the outlook impact, and recommend specific follow-up actions. Focus on establishing a reliable baseline, decomposing price volume mix and timing effects, identifying controllable versus non-controllable drivers, validating data, and communicating actions rather than merely reporting differences. Question 15. Tell me about a time you used Excel or data tools to improve analysis. In a prior project, I consolidated several monthly files into a standardized Excel model using Power Query, structured tables, pivot tables, and validation checks. The previous process required repeated manual copying and made version control difficult. I automated the refresh, created an exception report, and reconciled totals to the source systems before sharing results. The process reduced preparation time substantially and improved consistency. I learned that automation is valuable only when controls and transparent documentation remain in place. Be sure to provide a specific situation, explain the dataset and business problem, describe formulas, pivots, SQL, or automation used, quantify the improvement, and mention validation controls. Question 16. How would you investigate a data quality issue in a financial report? I would first define the discrepancy precisely, including the affected metric, period, product, and dollar impact. Then I would trace the number from the report back through transformations, mappings, source systems, and accounting entries. I would check duplicate records, missing data, cutoff timing, sign conventions, and manual overrides. After reconciling to a trusted source, I would document the root cause, correct the output, assess prior period impact, and recommend a preventive control. Mention defining the discrepancy, tracing source to report data, checking mappings and period cutoffs, reconciling totals, documenting root cause, correcting controls, and communicating impact promptly. Question 17. What is the difference between generally accepted accounting principles and statutory accounting for insurers? Generally accepted accounting principles is designed primarily to provide useful financial information to investors and other stakeholders, while statutory accounting supports regulators in evaluating an insurer's solvency and ability to pay claims. Statutory accounting is generally more conservative, including rules around admitted assets, reserves, and capital or surplus. I would understand which basis a report uses before interpreting performance. Generally accepted accounting principles helps assess profitability and comparability. Statutory results help assess financial strength, regulatory compliance, and capacity to write business. In your answer, distinguish investor-oriented generally accepted accounting principles from regulator-focused statutory accounting, discuss conservatism, admitted assets, capital and surplus, reserve treatment, and why both views matter to management. Question 18. How would you assess an insurer's liquidity and capital position? I would compare liquid assets and expected operating cash flows with projected claim payments, expenses, debt obligations, and collateral needs. I would review investment duration, asset quality, reinsurance recoverables, statutory surplus, and relevant risk-based capital measures. Stress testing should include severe catastrophe losses, elevated claims inflation, market value declines, and reduced investment income. A strong position is not simply excess cash, it is sufficient accessible capital and liquidity while preserving prudent portfolio returns. Focus on liquid assets, expected claim payments, operating cash flows, investment duration, reinsurance receivables, statutory surplus, risk-based capital, catastrophe stress, and balancing safety with investment returns. Question 19. Tell me about a time you explained complex financial information to a non-financial stakeholder. I once explained an unfavorable budget variance to an operations manager who did not work with financial terminology. Instead of leading with accounting details, I showed that the variance came mainly from higher transaction volume and temporary staffing, using a simple bridge chart. I explained which portion was controllable and which reflected demand. After confirming understanding, we agreed on revised staffing assumptions and a monitoring threshold. That experience reinforced the importance of clarity, context, and actionable recommendations. Make sure to use a clear star structure, simplify technical language, lead with the business implication, use a focused visual or example, confirm understanding, and explain how the stakeholder acted on your analysis. Question 20. Suppose premium growth is strong, but the combined ratio is worsening. What would you recommend? I would not treat premium growth as automatically positive. I would test whether new business is underpriced, concentrated in higher risk segments, or generating unfavorable claims frequency and severity. I would also separate catastrophe effects, reserve development, expense inflation, and timing from underlying accident year performance. My recommendation might include targeted rate action, tighter underwriting, improved claims controls, or slowing unprofitable growth. I would quantify the trade-offs through scenarios, including retention, policy volume, earnings, and capital impact. Be sure to analyze whether growth is profitable, examine pricing adequacy, mix, retention, frequency, severity, catastrophes, expenses, reserve development, and propose actions supported by scenario analysis. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.